Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant here, host of the Smart Property Investments Show, trying to work out what's going on with property in Australia at the moment. No one knows. Everyone's got conflicting opinions. Went to a couple of auctions over the weekend and I was quite surprised by just how far they went over to reserve. So I try to make sense of it all like everyone else. And at the moment, we've got this dichotomy of the realities of the ground truth and what's happening any given Saturday, whether it's auctions or private treaty during the week, versus where the data is, which normally has a bit of a lag. So if you're making decisions based on the data you're getting now versus what's happening in the market, you may be disappointed and you're going to be one of those thousands of Australians who are turning up at auctions and missing out. Let's find out what's going on. Andrew Wilson, Chief Economist, My Housing Markets, joining me in the studio, is back. Good friend of the Smart Property Investment Show, regular guest. Andrew, how you going?
I'm good, Phil, and I'm not so sure there's too much doubt in the property market at the moment. If you're a buyer, you know for sure that it's really hard work out there to get hold of a property, and I think it's got some way to run yet.
You reckon?
Yeah, absolutely.
Mate, I'm hearing otherwise. I reckon, I must have had 3 or 4 conversations. I've picked through, obviously, the auction results over the weekend past. And speaking to people who are in the know, and they're going, yeah, I reckon it's starting to, the rapid speed of price growth is starting to wane and they're starting to see it flatten out a little bit. Ground truth, I'm told. You say otherwise?
No, look, absolutely. We couldn't sustain what we've seen over March, Phil. It's just extraordinary growth. And it's all about, releasing the dam walls, and all that pent-up demand has flowed into the marketplace. And, that's added to by enthusiasm and FOMO and all those animal spirits that have got people up and about. But the point is, the reason why we've got some way to run, and by some way I mean, through to the end of this year, is that we've still got quite significant affordability advantages in the market. Now, even though Sydney's recorded, as an example, the strongest price growth this year so far that it's seen since the crazy days of 1989, where it was just a flood of money in all markets globally. We're just behind that level. If you go back 4 years, Sydney's house prices have only increased by around 7%. And if you take inflation away from that 7%, it's hardly moved at all. And of course, since then, we've had a near 2% decline in mortgage rates and around about a 6% increase in income. So that's why affordability is strong, because you're basically paying the same as you did 4 years ago for a property in Sydney in real terms. And yet you've got all this extra cash to spend because your incomes have grown and you've got a sharply reduced mortgage rate. Now, eventually, with prices increasing as they are, you'll run out of money because you won't be able to go to the bank manager and say, can I have an extra 100 grand because I've got to pay that, or extra 200 grand or an extra $1 million to secure a property. Now, the bank manager is going to say, well, are you earning any more? And well, no. Oh, I can't give you a lower mortgage rate, so I'm sorry, but you no longer are a buyer for that particular property. And of course, that just starts to sideline buyers because affordability barriers start to impact the capacity to buy. Now, that's what we will see this year. We're already seeing some early signs of that, moving from the heady, crazy numbers of the March quarter into something that's still almost thermonuclear anyway in terms of prices growth, but a lot more sustainable because we are seeing buyers priced out of the market slowly. So, look, in a way, it's sort of eminently predictable, Phil, what's happening. And even the recent auction clearance rates, and we had a holiday month in April. Yeah. We had fewer buyers and sellers in the market because they're distracted, of course, holidays. We also see fewer higher priced properties in the market, and therefore medians tend to look lower because of the mix of properties that are sold during that April holiday month. But nevertheless, coming into May, when all the distractions were behind us, we're still getting mid 80% clearance rates in Sydney, over 80% in Melbourne, and over 90% in Canberra and mid-80s in Adelaide and, nearly 80% in Brisbane. This is a very strong, overall market environment. No capitals are missing out at the moment. And as I said, there's still some way to run as we catch up to where we should have been if we hadn't have had all the roadblocks in the last 4 years.
And that's the catch-up, Andrew, that I really wanted to get some sense for. So if you're new to property investment and you started buying, say, in October of last year, 2020, you probably think you're a genius, right? You're probably sitting there thinking, hey, how good is this property game? Look at me, I'll make it. What was the numbers in March? What did they go up just in March in Sydney, Andrew? You know 8%, the number?
Okay. Yeah, 8%. So that's 8% over a quarter. You multiply that by 4, and that's 32% over a year.
So you think you're an absolute genius. Yeah. And I saw this I started investing in 2012 and bought at the right time, bought the right sort of assets. And mate, I thought I was a property legend. The spate of growth I had, but I subsequently held that portfolio during that period of 2018 through to 2020. So this is the normalizing of the market. So if you've had property during that period of time, it probably went backwards, and this is just bouncing back to where it should have done. And you're an economist, so you know what you're doing in property. Property doesn't move in a linear direction, but over time it sort of moves in a standardized way, which is largely predictable if you look at it over a period of decades. Yes?
Absolutely. And the reason that occurs, Phil, is because it moves with interest rates. And as we know, interest rates are that volatile element, or have been that volatile element in the whole housing or house price cycle. Now, the interesting thing going forward now is that our interest rate cycle is as flat as a tack. The inflation genie, the interest rate genie is back in the bottle. So going forward, we will have a little bit more of a linear model in house price growth because we've killed interest rates, we've killed inflation, and there's no prospect of higher inflation in the foreseeable future. And I'm talking years here, and that means there's no prospect of higher interest rates for the foreseeable future. Again, we're talking years. So the only way you're going to be able to pay more for a property is if you increase your income. And income growth is the lowest we've ever seen. So we are going to have a much flatter period for house price growth. That doesn't mean they won't grow, Phil. Prices will continue to rise, but it won't be that roller coaster ride of the last few decades where, as you said, once you even it out, you get to a more substantial underlying result. We're going to see that result, that more predictable underlying result, evident rather than having to wait for it over the ups and downs of the cycle. So this is just getting rid of all the energy that's been held back in the market since the credit squeeze issues started in late 2017. We've had the Royal Commission into the banking sector, we've had the last election, and we've had COVID, of course, which just kept buyer activity on the sidelines. Now, it's all behind us now. We've got a good economy going forward, an improving economy going forward. Confidence is there, and this will just run out of steam, I believe, as the year progresses. We're getting early signs of that, but that doesn't mean prices won't continue to grow, Phil. We're undersupplied in most of our capital city markets. Aspiration for home ownership is still strong. The investors are now back in the market. The latest data, which was released just recently for home lending over March, no surprise, has seen an incredible surge in investor lending, up 12.7% over March. So investors obviously are alert to the potential for capital growth and are now coming back into the marketplace. So they will take up the mantle of, particularly first home buyers that are likely now to be pushed out of the market because prices are just too high for them.
So we're chatting about this interconnectivity between interest rates and price growth, and applying into that inflation is a component of it. Now it's 12:15 on the first Tuesday of May. We know that in a couple of hours, the RBA is going to come out and tell us what they're going to do with interest rates. So you're happy to go on the record right now, 2 hours before the decision, and say they won't move?
Well, look, if they're a safer bet in the country about the direction of interest rates, it's 0.1% officially at the moment, Phil. Now, why would you move that 0.1% downwards? Well, it's not going to make any difference. It's just going to have the headline of interest rates are zero. I'm not sure the banks would be too happy about that, given they've already just about got a zero deposit rate for anybody who's still got their money in the bank. And the prospects of a higher interest rate are becoming even more remote. We had the CPI data for the March quarter was released a week ago. there was some speculation that we may see increase in the inflation rate. That got the dogs barking about, oh, yeah, we'll see higher inflation. That means interest rates are going to start rising soon, cheap headline as usual. Now, even though there was a reasonable case that inflation would have increased over the March quarter, and that case is all about the end of the government policies that have been suppressing prices last year, the government policies that have been supporting such things as building, has been supporting childcare, have kept prices quite flat. In fact, the lowest inflation we've seen. And that, of course, has now ended those support packages, which would have meant that we'll start to see inflation rising again. But we didn't see it. In fact, inflation fell again over the March quarter, down to just 0.6%. Now, inflation will rise, Phil, over coming quarters because we are moving out of that support period from the COVID policies. But underlying inflation is not going anywhere. In fact, underlying inflation, which takes out all the bumps in the data, is at the lowest level ever. So the prospects are just as remote now, even with higher inflation as the economy adjusts post-COVID. The prospects of higher interest rates couldn't be further away now than they've ever been. And, how long is a piece of string here? Reserve Bank says 4% unemployment. That's what they reckon it's going to take to get inflation running again, incomes running again. We're at 5.6. We've got to create 1 million jobs to get to that. Now,
they're happening. The jobs are coming out all over the joint at the moment. And in particular, we've got, 10, 15 roles we're trying to fill right now. Do you think you could find people right now? No, it's not the way it is. But I just want to step it back a bit, Andrew, and you're an economist, so you know about this stuff. I obviously did my high school economics, right? And I know a little bit about property. So this term of inflation is bandied around a lot. And you speak to people, they always go, oh, inflation this, inflation that. Can you just give me and our listeners who might not be too au fait with it, a lesson on inflation? What is inflation? Why does it matter? Why is it a tool or a lever for a government to create stability? And what's the next 5 years going to look like?
Well, inflation is just the measure of prices growth in the economy, Phil. And they take a basket of goods, a typical basket of goods on a quarter-to-quarter basis, and that includes things like rent and costs of everything, of building costs. And then they measure it from that quarter-to-quarter period to see how that's changing. Now, inflation wasn't really, it's always been an issue in economics because if prices rise too quickly, what happens, of course, is that the value of your money declines. And if that gets away, because what happens as prices rise, of course, is that workers need to have more money to cover price rises. So they ask for wage increases. And the scary thing is you can get into a prices wage spiral, which is that, prices rise, workers ask for more money to cover those price rises. Then the businesses that produce the goods and services have to raise prices to cover the increased wages. And on we go. And that's a wages prices spiral. And that's the sort of thing that leads to, we've had crazy, hyperinflation in certain economies over the journey, the last century. But the real issue for the modern economies was what happened in the early 70s, when we did see that wage price inflation spiral happening and inflation moved up to 10%. And then we had that position where, well, what do you control first, prices or do you control incomes? So it was monetary policy that has eventually got inflation under control. And it's a very scary thing, as you can imagine, if it does get out of control. So interest rates are used to control it, because if prices start to rise beyond what the Reserve Bank has as a target, and their target is between 2 and 3%. Now, there's plenty of arguments to say, well, how can you have a target when everything's changing, and 2 to 3% might not be relevant anymore, which it's not, of course, with inflation, at under 1%. But the Reserve Bank uses higher interest rates to take the heat out of the economy by having consumers not have the same capacity to buy, right, which then moderates economic activity and puts it down. And of course, businesses don't have the same capacity to invest because they have to pay more for their business loans. So that controls the economy and keeps inflation in a downward, or at least in a steady environment. But the point to that is now that we don't have any prospect of an inflationary outbreak, because we would probably need to be looking at higher interest rates now, which we normally see when house prices are growing strongly, because it usually means the rest of the economy is growing strongly. But the point is, nobody's going to be raising interest rates now, because it would, just put the kiss of death on an economy that's just starting to look better after COVID. So inflation is important. It does reflect what's happening in terms of interest rates, but it's obviously very important for the housing market, because we know that house prices and housing market activity is very sensitive to interest rate movements. And I'm always surprised that the Reserve Bank seems to take a long time to understand the relationship between changes in interest rates and changes in house prices, right?
And this is the difference. And I spoke about this other podcast in the dynamics of property, as in what's happening versus the numbers, the two very different things. And I'll have a chat about that. Go to break beforehand, back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Andrew Wilson. He's the chief economist of my housing market. He's been doing this for quite some time. Now, we're talking about the apparatus of government to control inflation and therefore stimulate sustainable economic growth. So that's just I think you've given a really nice, simple 101 lesson on how it all works together. Now, the main lever that the government has, the government being whoever's sitting in power at any given time and the mechanics of government, is the setting of interest rates. So if the official cash rate is really, really low, essentially what they're indicating to banks, as in, where most of us get our mortgages from, is, hey, let's make it really cheap to get debt. And therefore more people will be in a market, which will stimulate economic activity when it comes to property. And probably a point that you've made to me in the past, Andrew, is that most Australians, their connectivity with the wealth effect of their property will dictate their attitude to buying other stuff, TVs, cars, overseas holidays. So the keystone to this whole equation is the cash rate and Australians' ability to borrow money.
Well, that's right. And the point is, now we're in an environment where we've got nothing left in the bank, in the kitty. Interest rates, can't go any lower. So we've done all we can with monetary policy to get the economy up and running. And we are up and running, but we're coming from a low base. We need to have a much stronger economic performance to get back to the key to all of this, and that is higher incomes, Phil. We go back to 2010-11, where we had the end of what was mining boom number 2, and that's the last time we had an increase in interest rates. That's 10 years ago, Phil, since our last increase in interest rates. Well, incomes then were tracking at around 4% per year. In terms of incomes growth. We're now under 1% per year. So that's the point. We've got to get back to 4% a year incomes growth to create the sort of inflation and energy where we would need to take the heat out of the economy by increasing interest rates.
Wow.
I hope it happens. I hope it happens tomorrow. But it's not gonna, mate.
How do Australians get paid more money, Andrew? How do you put upwards pressure on incomes? Because, mate, I feel like I'm handing out pay rises left, right, and centre. So who isn't doing that?
Well, that's the start of the issue. You need to have competition for labour. So your economy needs to have enough energy in it, enough growth, where you're running out of labour. So you've got more demand than you have supply, and therefore workers start to compete with each other for higher wages, right? So now in a modern economy, workers compete around productivity. So we used to have different forms of centralised wage setting, which tended to push wages up in areas which weren't productive. Now you basically need to be able to show that you're improving your productivity to get a wage rise, right? Which is a good thing to have that. But at the end of the day, it is about competition, and you as an employer will have to start paying higher wages, right, to be able to secure the employees you need to be profitable, right? But it gets to a point where, you're going to have, if you have to pay too much, you're going to have to start thinking about, well, maybe I've got to put up some prices here to cover my increased labour costs. And then we start in that sort of inflation environment. But the point is we don't have an economy which is creating all that competition on a full economy basis to be able to push incomes up. And we're a long way from that. But what you're saying from your experience is a good start. Yeah. And that's what we're doing now. We are starting that journey back, but we are going to need to find more jobs for that 5.5% unemployment that we had at the moment. And you've got to understand, even before we entered into the COVID lockdown, the unemployment rate was 5.2%. And the Reserve Bank was cutting interest rates then because they weren't happy with that. And incomes were still flat then. So they're saying now, and they've finally realised that they need a 4% something unemployment rate. They think at least to get that sort of competition to start pushing up incomes, right, to get to the point where inflation would be rising and interest rates would be rising. Now, in America, they got to 3% pre-COVID, Phil, unemployment rates, and it still wasn't creating income. The point is maybe we're seeing some substantial shifts in the way we manage our labour markets. Even if we have full employment, we don't necessarily get the big surge in wages that we would expect or that we've had in previous strong growth periods. And that might be technological, it might be migration, it might be a number of factors that have changed that mean that we don't get that breakout, that strong breakout in wages growth. But maybe that's not a bad thing, mate.
It's not a bad thing. Maybe this is just the way it's going to work for this next period of time. We've seen a wholesale shift in the way that people work. And, you only got to think back to medieval England, and most things were cottage industries, people working from home, doing their little bit to contribute to some sort of centralised factory. We've sort of gone back in time now with everyone sitting in their own home office now doing their little bit to contribute to a centralised economic function. Now, do you think the government's got to let things run as it is right now? There's not too much more they can functionally do unless they pump stimulus directly into the pockets of people. You see some childcare stuff happening right now. We're moving up into an election soon. What more can the government do? And the second part of that question is, I don't think we're going to see an election this year. I think we'll wait to see how the government does its vaccine rollout. Expect to see the election next year. Is that going to matter too much about how this sort of shapes out?
No, look, I think Australia's in a very fortunate position, Phil, because once we've lost the energy from interest rate policy, from monetary policy, which we have, and that's a global phenomenon, interest rates are zero everywhere. So we're not alone here. This isn't an Australian sort of issue in terms of not being able to create incomes with our cuts to interest rates over the last decade. Everyone else is in the same boat. Yeah. So what that means is there's only one thing left, and that's to spend, and that's about government spending. So it's fiscal policy to stimulate economies. Now, Australia's been really fortunate here because with the rest of the world, of course, they're spending like a drunken sailor, and that's what you've got to do to recover from COVID. And of course, that means high levels of debt notionally. But you see, Australia's come into this event, this COVID event, to re-stimulate economies through monetary policy, through fiscal policy, in a better position than anywhere else. I mean, the US had a deficit of 4% of GDP prior to COVID. We were in a balanced budget position, just about. So it's all about relative debt when you talk about, we've got to pay back all this debt. Well, so's the rest of the world got to pay back their debt. And Australia actually is in a better position because it's come from a higher point in terms of how indebted it was at the beginning of COVID. And of course, the other point is that we are a strong exporting country. We've seen, again, lucky country, it's working for us. Iron ore looking like heading $200 a tonne. You know, the mining boom that's happening in terms of the volume and value of iron ore particularly, and coal, is creating, sort of rivers of gold into our resource sector, which is helping us fund our spending. And the other point to that is, of course, as with most advanced economies, we're moving into quantitative easing, which means the central bank is facilitating the buying of government bonds, right? So there's been, hundreds of billions of dollars worth of government bonds that the Reserve Bank has been involved in the purchase of through third parties, of course. But most of those bonds have been directed towards state governments. So state governments are in this position where they're having all this demand for their debentures, for their bonds, which is bringing money in for them that they can use to support their economies. And the point to the debt also is that interest rates are so low for government debt right, that there's not the same implication for that sort of repayment facility. And the other interesting point is because Australia is now rated so highly in terms of its economic performance, there's actually a lot of competition for Australian government bonds from outside Australia, right? So it's a win-win really across the board. And all you have to do is look at how strong the Australian dollar is, Phil, just to understand how the rest of the world is marking Australia at the moment in terms of all those factors, our improving economy, our debt levels, our export performance. The rest of the world wants to buy into Australia. And that's why, our dollar is certainly, again, looking likely to head
doing well
over 80 cents.
Yeah. Can you sort of, again, getting back to basics, you spoke about government bonds there and the machinations of that. I might have missed a few people listening to this. So can you just explain what is a government bond and how the implication of that around debt and the attractiveness of Australia as a result of it?
Well, a government bond is a way that governments use to raise money because they say, well, look, you give us X, we'll give you a bond which says we'll pay you this amount of interest on that amount of money that we've taken from you, we've borrowed from you, and we'll repay it within 3 years or 5 years at that rate of interest.
And
right?
who are governments borrowing this money from? Is it
from anybody.
Sovereign debt or is it?
Well, they borrow that from anybody can buy a government bond, but obviously the big players, are other state governments or large financial institutions such as banks, right? And it's part of the way that they spread their risk in terms of their investment portfolios, whether they're a large financial institution or a government, right? One of the other theories, other than financing government debt through purchasing bonds, one of the other issues was that if there's strong demand, this is what quantitative easing was also supposed to do. If you get a strong demand for a particular bond or for government bonds, what it tends to do is it pushes down the yield because the interest rates are fixed, but the value of the bond actually rises because people want it. So they push up the price of the bond, right? And that lower yield pushes down interest rates, right? And what that's theoretically supposed to do is it pushes down the rate of interest on non-secured lending, such as personal loans or credit cards, right? But that hasn't happened, because the banks aren't mugs. I mean, credit card interest rates and personal loan interest
still
rates
up there, still 21+%.
Still up there.
It's a license to print money.
Yeah, and that was supposed to be another way of getting interest rates down so people would have more money to spend to stimulate the economy.
It's called Afterpay now, Andrew. It's called Afterpay. You don't have to pay 21% at Afterpay anymore.
That's right.
It's the reason why Afterpay share price is going absolutely berserk. So we're getting a bit of economic lessons here, and I hope everyone there's heaps of information like this on smartpropertyinvestment.com.au. You don't need to be an expert on it. However, it's good to be informed around it because it can help give you some indication of how cheap money is going to be moving forward. Now, Andrew, we're talking about these levers of how the government can promote economic growth. How much tinkering, and we saw back in 2017, 2018, when the government went, hang on a second, we've got to sort of slow things down a bit, which had its impact. And there was a lot of criticism around that because they went, well, you applied national policy against trying to deal with a couple of states. Poor old Western Australia and Perth was hemorrhaging and just made it worse. So there was criticism around that. So how much tinkering do you think the government is going to have in lending policy for banks moving forward? They're just going to let it go now? They're quite happy with it all?
Well, thankfully, yes, is the answer to that question, Phil. I personally believe that APRA particularly got their fingers burnt by moving into the market as they did in 14-15 and 17-18 because they thought there was too much risk, particularly in respect to investor activity in our housing markets. Now, the whole premise to that risk was that they were convinced, as the Reserve Bank was, that the next move in interest rates would be up, right? Of course, we know how that ended up. And that if the interest rates did increase, they were concerned that there would be risks to higher leveraged investors who would have to move out of their investment and create, a fire sale environment in some markets. So they wanted to avoid that. Of course, that would hurt banks, and APRA are responsible for bank lending, risk management. But the point is that at that time, it was really only the Sydney market that was in any way, I guess, characterised as being, unstable because of a 60% market share by investors, even though I personally think that would have just worked its way out. But the rest of it, the country, as you said, had to pay the price of a credit squeeze. And, one of the offsets to that was that we stopped building. And, we're down around 40% in terms of the new dwelling levels at the moment that are being approved compared to way back in 2017. And if it wasn't for shut borders, we'd be starting to see housing shortages emerge in a number of capital cities, which I still believe is a prospect once we get back to a more normalised environment with migration. So, it's sort of creating those consequences that are unforeseen when you interfere in particular specific markets. Now, APRA said, well, we don't care about the economy per se. We're all about managing risk for banks. Well, that's fine. But the Reserve Bank was cheering them on at that point of time. And one of the key issues that is questioned, and I've been questioning it for a while, was that if we go back 3 or 4 years, the Reserve Bank held interest rates at a record level for nearly 2 years. And there were questions there that maybe they held it too high for too long because they were worried about reheating the housing market, right? Whereas what they did is they stopped the economy generally from growing because they kept rates too high. And by the time they moved into cut rates, it was too late, right?
Last thing we need now is handbrakes on economic growth. It won't happen. We'll go to another break. When we come back, let's chat a little bit around property prices. Back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, Smart Property Investment with Andrew Wilson, Chief Economist at My Housing Market. We spoke before the break, Andrew, about letting the economy run. The government, I believe, is highly incentivised in capitalising on what is going to be a unique period of time for Australia moving forward. And then particularly in our neighbourhood as an export nation, and our neighbourhood is contested. You only need to pick up a paper at any point in time at the moment, and you're hearing about some of the drum beats of war, inverted commas, with China, some pretty inflammatory language which I think is being tempered. My personal view is Australia's sovereignty is key and core and is a big focus at the moment, but we live in a globalised economy. We need to make sure we have those trusted trading partners to help stimulate economic growth, because all Australia's benefits from that, but not at the compromise of our sovereignty. So outside of our pay grade to talk about that sort of stuff, Andrew, but give me some sense, mate. We're talking about an election, and I don't want to get political with this, but can you see the opposition coming out with any policies which are going to be potentially challenging people's rice bowl in terms of the wealth of their property this coming campaign?
No, I think the thing, Phil, is interesting that we've sort of had the stimulating policies for the housing market brought forward. And they were obviously the first port of call, as they usually are, when we do hit the skids in the economy. We look to the housing market to get up and running quickly, firstly through lower interest rates, then through policies directed at particular parts of the market. And that, of course, is usually first home buyers and, of course, the building industry. And the government have done that in spades, and state governments have assisted. And it's certainly been a key factor of creating the momentum or adding to the momentum that was always underlying and ready to be released in our housing markets, right? So it's been a very positive period in terms of the government policy response and how the housing markets have responded to that. So they've had their day, and I don't think we're going to see anything going forward. In fact, most of those policies have now expired or are being marginalised because of higher prices. And I think that's fair enough. And in a way, that's almost a quasi handbrake on higher price growth, that those policies are now no longer driving the demand that they did at the back end of 2020 and into the early 2021. But so I think the government will focus on job creation, more specifically, infrastructure spending, targeted assistance to particular industries, middle-class welfare. And by that, I mean, childcare assistance, which isn't necessarily middle class, I suppose, shouldn't have said that. But, and also, perhaps looking at the tax mix as well, to try to stimulate more investment through some directed tax incentives for business.
Yeah. Do you think it's going to be a pretty benign budget next week? So the budget's handed down on Tuesday, right?
Yeah, Tuesday evening, yeah.
Yeah, Tuesday evening. Yeah, so pretty benign.
Yeah, we'll sort of know probably anyway the day before because of the leaks if there's any sort of a big problem, but they're still going to spend money. I mean, the government's position is, as I said, we are reinforcing the fact that we are the lucky country because the government's deficit position is $30 billion better than they thought it would have been. So notionally, they've got an extra $30 billion to spend if they want to. So it's just a matter of targeted assistance. But I think they'll leave the property market alone because it's already had and done its job. It's had its big sugar hit last year, and it's working its way through the system in more of a natural environment rather than one that's being artificially stimulated.
Yeah.
But I do think, the tax mix is important as not just for businesses, but also for taxpayers, consumers, and that'll be part of the drive for continuing to see our remarkable recovery, pushing us back to the time where we can start thinking about regaining all that lost prosperity of the last decade, Phil.
Yeah. And politics aside for the moment, I think most Australians would be considerate of our position as a nation coming out of COVID-19 and whether or not that's luck or chance or the fact that we're an island home or whether it's very good management by the government and some very smart, and I'd sort of go on the record with this, some pretty smart stimulus, the application of that stimulus in JobKeeper. And that was really, really smart stuff. And now we're all going to benefit from it. So, we see in New Zealand at the moment, I know you keep an eye on that market, some pretty curly challenges for property investors out there with the application of interest deductions on property. I can't see the opposition of Labor government coming out saying we're removing negative gearing as part of their election platform come when that happens.
No, they won't. And look, there's a couple of positive reasons. Even though we are seeing an absolutely predictable revival in investor activity, we've got to understand that the level of investor activity has been absolutely dreadful. It's, investors have had to confront a credit squeeze for the last 2 or 3 years. It's very difficult still to get loans from the banks. If you are an investor, there's been a lack of product to identify as an investor with the problems with inner city apartments. But that's all now obviously a thing of the past. We are seeing investor levels now are back to where they were in 2017, but they're still well behind where they were at their peak levels, Phil, and they're well down on average levels. I mean, average investor market activity is around about 33% of all lending. It's now pushing up into the mid-20s, but it's still well behind where it is traditionally, and particularly where it is in strong market price outbreaks as we have at the moment. So there's really nothing there that can be in any sense overbalanced, and you don't need to be targeting investors in any way to try to sort of rebalance the markets as that negative gearing push was supposed to. Yeah. And of course, we've had record levels or near record levels of first home buyers over the past 18 months. So,
it's an interesting market we're in, and I reckon the intent is there for investors if they could actually, number one, get a home loan pretty easy. And it's not like the banks don't want to lend. You just got to go through a lot of hoops in order to get a mortgage. And the second thing is trying to get yourself a property, right? There's so many first-home buyers and other people in the market. I think that's got something to do with the level of investor activity. So and I'll conclude with this question, Andrew, how far is this market going to run? And look, we're talking about a whole bunch of different sub-markets and locations and regions and stuff. But as a catch-all, let's talk Sydney because I'm here. Yes. How far is this market going to run, mate? Where's it going to cap out at compared to where it really started moving in the gear, which I'd probably call sort of August, September last year?
Yeah, that's right. And look, we started the last year off strongly before COVID, Phil. We were starting to revive then, and then COVID came along. So that just put it all off for another, year. Yeah. I think by the end of the year, we'll start to see in Sydney quarterly growth rates of between 1% and 2%. That's compared to 8% over the March quarter. I think the March quarter in all markets will be the peak of this cycle. And I think that by the December quarter, we would have started to run out of gas, and to be able to see it. But going forward, I think that 1%, around about 1% per quarter will be roughly where housing markets head next year. There's nothing to refuel prices growth once we've hit those affordability barriers, which are coming, because we can't cut rates. Incomes growth is still low. So we'll just chug along at around about a 3 or 4% per year rate going forward. And that's actually a pretty positive environment. And interestingly enough, if you average the growth of house prices over, and given that inflation's just about, 1%, you're making a real gain of around 3%. But if you look at averaging out prices growth over the last few decades, it comes in at around 3 or 4% a year anyway, you know.
So the takeaway from this is don't get swept up in all the FOMO, the noise around 8% price growth at the moment and property's going absolutely berserk. It's just normalization of the market, catching up to where it was and should be. Yeah. And over time and moving forward, property will remain an attractive asset class because of the predictability of the continuity of growth. It just depends how it comes and when it comes.
And that's because interest rates are a dead duck. They're gone. We don't have to worry about the roller coaster because all we have to do is wait for interest rates to rise. And, you know, that could be a decade, another decade before that happens.
Well, great. Get stuck in then. So if you had some money at the moment, Andrew, would you be putting it in property?
Oh, absolutely, because we know there's still growth left. We've just hit the peak growth rate, but we've still got plenty of upside. Those auction clearance rates are still remarkable.
Oh, off the charts, it was 90+% in Canberra, I think, over the weekend.
We would need to be seeing them drop down to 60s to start to really be thinking about a market where prices growth is flattened, you know, has flattened. So we've got a long, long way to go before we get to that. And there's still a lot of demand out there that has to be satisfied. And prices, as I said, are basically still in real terms back where they were in 2017. So look, prices will continue to rise, Phil, but they won't rise at the sort of rate we've seen over the first quarter of this year, which was just cloud cuckoo land stuff.
Yeah, it is. Well, very considered analysis, Andrew, on that. And look, you know, we'll have to get back in a podcast. We can't touch on it today for time, but I think we're just going to do this application of what happens when borders opens up as well, because that's going to throw another element in the mix. That's Andrew Wilson, Chief Economist, My Housing Market. Really appreciate it, Andrew. Thanks for the economic lesson as well. I'm sure that would resonate with all our listeners. It's good to, I don't want to call it dumb it down, but just to simplify some of these. You need to know these basic building blocks. You don't have to be an expert, but look, if you don't know about it, you can get educated on it. Go and read. But Andrew, thanks for your time today.
Yeah, great, Phil. Great to be here, mate.
Nice one. Hope you enjoyed that, everyone. There's heaps of stuff on this on smartpropertyinvestment.com.au. Go and check it out. If you've got any specific questions at all around anything we spoke about with inflation or government bonds or how it all works and what it all means, send your questions in. We'll get them answered. editor@smartpropertyinvestment.com.au. That's where we'll pick up that. Remember, tell your friends about what we do in this podcast if they're interested in property. Traffic's through the roof at the moment on smartpropertyinvestment.com.au. So obviously a lot of punters out there trying to get some skin in the game. And to Andrew's point, it is a good asset class and it has some legs still in it. smartpropertyinvestment.com.au. You can subscribe there as well. And wherever you listen to this, whichever podcast player, please keep those reviews coming. The team really get a kick out of it. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
This past year, we've all experienced isolation and uncertainty. For kids living with serious illness, like 7-year-old Annabella, this is something they feel every day. This Starlight Day, you can give happiness to thousands of seriously ill children like Annabella, and donations made before Sunday 9th of May will be matched by a generous Starlight partner. Donate today at starlightday.org.au.